Good morning, good afternoon, and good evening, everyone, and welcome to How to Manage Success for SaaS Companies. My name is Colin Mahan, and I'm a Director of Programs at the NASDAQ Entrepreneurial Center. And for those of you who may not know, the NASDAQ Center is a nonprofit that's building a better path for entrepreneurs worldwide by improving inclusion, access, and knowledge in entrepreneurship. As you're going to see in the chat in just a moment, the NASDAQ Center provides programs, resources, and exceptional mentorship to entrepreneurs across all races, industries, and geographies. So check out those links and resources in the chat. Got a couple of housekeeping items before we get started. Firstly, let us know where you're dialing in from in the chat. We get to see where you're coming from. Secondly, we're going to open up for live Q&A near the end of this session, so please submit those questions for us in the bottom of your screen throughout the presentation. We'll try our best to get to them all. Now, none of what we do here at the center would be possible without all the amazing support from our sponsors, including NASDAQ, Lehigh University, BMO, Airbnb, KPMG, Wilson Sonsini, Microsoft Entrepreneurship for Positive Impact, BPM, and HubSpot for Startups. We're humbled by their contributions and hope you're grateful too. Now, before we get started, I'm going to launch a couple polls to step back and take a temperature gauge on how all of you are doing today. So the first one, how are you feeling about your business? It's 2024. Can't believe it's almost the end of February. Are you optimistic, in survival mode? How are you feeling about your business? Ooh, looks like optimism is in the lead. I'm going to let this roll for a second. More. Alrighty, I'm going to end this poll. Share those results. Looks like optimism is in the lead, which is awesome. And the second poll I'm going to launch is what's keeping you up at night. We use this information to provide data on what we should be offering you in the next couple of months. So let us know where you're struggling in your business, and we'll get right to it. Let's see. I'm looking at where we're coming from. Philly, Lancaster. Let's see. New York, Florida. Awesome. DC, bunch. Okay. Well, I'm going to end this poll. Share those results. Looks like sales is at the top of the key on this one, which is good news for our special guest because that's the topic for today. So, without any further delay, please join me in giving a warm welcome to our special guest, Eric Mersch. He's a partner at FLG Partners and author of Hack SaaS, an insider's guide to managing software business success. Eric, welcome.
Thank you, everyone, and thanks for having me here.
Awesome. Well, let's just jump right in. So can you begin by highlighting some of the key milestones or pivotal moments that have shaped trajectory of SaaS business models over the years?
Well, this is a great question. I appreciate being given a chance to talk about a bit of the history of how SaaS arose. And there were four key trends, and these all happened just before the turn of the century, and it paved the way for SaaS. And these were bandwidth, hardware, virtualization, and then the rise of cloud service providers. So a lot of in parallel, and a lot of that continues today. But bandwidth, during the dot-com business, tremendous amount of money flowed into these dot-com businesses, and they couldn't get their message out. People couldn't access them because bandwidth was short. So all this investment went into bandwidth, and even after the dot-com crash, those projects continued to play out. And then by sort of the mid-noughts, if you will, 2004, we had a tremendous amount of low-cost bandwidth because it was underutilized. So the second piece is hardware. Hardware continued along Moore's law, reducing cost by half, becoming more powerful. So it became more cost-effective to host your own software or to put it in the cloud, which is eventually what happened. Virtualization really exploded on the scene when VMware became big. And virtualization, a lot of people don't know this, but a typical server running without virtualization has a utilization of between 5 and 7% on average, with some spikes. But virtualization allowed servers to become 5 to 10 times more efficient, so more cost effective. And so all this was happening, and then then Amazon saw the opportunity to build a public cloud, and then things sort of took off from there. By 2008, it took 1/10 the cost to start a company as it did during the dot-com days. So more efficient, more centralized. The cloud providers they provided all the CapEx. So right now, SaaS companies don't buy anything, right? They have very little CapEx. So it made it very efficient to start. And then entrepreneurs started coming up with these ideas for SaaS applications.
Awesome. So how have these technological advancements shifted consumer behavior and influenced the development of these SaaS offerings?
Yeah, a couple things. So these new companies that exploded on the scene, these SaaS companies, but it became very accessible to the end user. So by 2010, nearly every household in America had fiber in the main cities, I guess, but had fiber connections. So it was very easy to access these applications. And the applications made people's lives more efficient, made business people's lives more efficient. And so it drove adoption far higher than anything we saw during the dot-com days.
So beyond the more commonly known metrics, as a CFO yourself, like monthly recurring revenue, aka MRR, and churn rate, what are some of the lesser known but equally significant metrics to evaluate SaaS performance?
Yeah, thank you. And yeah, let's get into the metrics part because it's exciting. But CAC payback period is a key metric that I don't often see companies manage. And the CAC payback period, well, let's break it down. CAC is customer acquisition cost, the cost to acquire an average individual customer. And that can be, a couple dollars for a business consumer SaaS. It can be thousands of dollars or tens of thousands of dollars for an enterprise company, a Fortune 500 company. We find CAC payback period more valuable in early stage companies when you're starting out. You don't have a lot of history. You don't have a lot of large data working for you. And so you track CAC payback period. And the payback period is typically provided in months, and it's the revenue you're generating from an individual marketing plan or marketing strategy for the customers onboarded as a result of that marketing.
And to double click into that a little bit, when you're in the early stages, what are some of the things you can do to measure that when it's kind of an unknown?
Yeah, that's great. And this is brings up a really great question. And I've worked with a bunch of early stage companies. And what you do is when you don't have the data, and this is also especially important in enterprise data, what you want to do is you want to lay out the metrics that you want to use to present to investors, and then you want to provide those investors with information about what it should be. Okay, so we have a CAC payback period. We don't know exactly how it's going to turn out, but we're looking at a 9-month payback period, as an example, and it varies from the type of business, but we're looking for a 9-month payback period. And if we get that, this is our cash requirement for a marketing strategy. And so having a knowledge of the metrics you want to use, the KPIs you want to measure your business against, and what they should be and how to get there, that's going to be key.
Helpful. How might SaaS businesses adapt their metric tracking and analysis as they scale from startup to enterprise level operations?
Yeah, this is great. So like I mentioned, every company, regardless of the customer you're serving, and we can get into that later, but you want to have these metrics sitting out there, and then you want to be able to use the operating data and then basically plug that in and begin calculating those metrics as you go. And so as you go, you should be able to, in smaller companies, you'll have daily activity in your marketing campaign. And so you'll use that, and then you want to validate all of your metrics, right? And for enterprise SaaS, this can be contracted annual recurring revenue, or it can be pipeline generation, or sales velocity, which is conversion of CAR into bookings, actual bookings, right? The pipeline to bookings conversion. In companies that serve consumers, you're going to look for by cohort. So in this month, we ran this campaign and we generated this much revenue in the following month. And these people have been staying. Even after 4 months, if you don't have the full data, you might have a retention of, say, 50%. And that's really good in that B2C world. So as you play it out, you're really going to focus on how the actual metrics compare to what you told the investors.
Mm. Can you share some examples on how analyzing and acting upon specific SaaS metrics has directly contributed to the success or turnaround of a software business?
Yeah, so I have a number of examples, but what I'll talk about here is pipeline coverage. Let's talk with pipeline coverage ratio. And this is valuable for companies that sell to I call them enterprise SaaS companies. They sell to the Fortune 1000 or the Global 1000, those companies that have appetite for $100,000 plus annual contract value. And the pipeline coverage is a ratio of the dollar value in the pipeline versus your bookings quota. You can do it by the rep too, right? And that pipeline coverage should be 5 to 7 times, because some fraction or some percentage of those leads in the pipeline will convert. And I see this a lot where a company will staff up its direct sales, but the pipeline's not there. And there's sort of reliance on these sales reps to go out and pitch and do outbound calls, especially in the early stages. So that's a key piece. Another piece in that, and just to stick with enterprise SaaS, because I think it's important, but a lot of startup companies miss this important piece of customer success, right? So the account executives, they land the deals and we pay them to land the deals, and they kind of go away off to the next deal. We don't pay them to maintain that relationship. And so a lot of companies are slow to introduce a customer success team. And that team is responsible for interacting with the customer, making sure the customer is using the data. And what we really want to get is not just renewals, which are important, obviously, but we want to get expansions. And expanding a company or capturing expansion contracted annual recurring revenue is about 1/5 the cost of landing a new logo. So if you can build a strong customer success, and it's hard to do because it's adding revenue or it's adding expense for revenue way down the line. And so companies will miss that. At smaller companies, we'll have at smaller companies, a lot of companies will get themselves in trouble in a business to consumer company, right? If you're selling to a consumer, and you go in and you say, okay, we're going to spend $100,000 on a marketing campaign in this month, and you get, maybe let's say you get 100,000 users or whatever, 100,000 new users, and they have high purchase intent, and they show staying power. So the immediate reaction is, okay, let's spend $200,000. Let's spend $300,000. And what they miss is that each incremental user, right, each incremental customer cost over 100% more than the prior user. So it's this exponential curve. So you can spend money and you're chasing these customers up this exponential curve. So you're increasing the price. So the assumption you had in month one of, yeah, I'm getting these folks for 10 cents or some number. Well, if you increase spend, you're not going to get people at that rate. You're going to get people at a lower rate. And the other issue that they run into is if you spend $100,000 today, your CAC payback period is 9 months. And so each month you spend, you're kind of digging yourself a working capital hole. And then if you expand spending, then you're sort of driving down you're increasing your cash needs so quickly that a lot of people can't respond. And if you're not prepared, either you have access to capital issues, but if you're not prepared to respond, then you're pulling back out of the market and you're losing all that momentum. So two, I think, good examples of how companies, when I've come in, I've educated the clients and produced good results.
Awesome. We had a question here coming from the audience around the metrics. Since they're non-GAAP, are they reported in financial statements and reconciled with GAAP metrics, or are they just mostly internal for managerial accounting?
Well, this is such a great question, and I see this all the time. Last year I saw this a lot as well. But these are non-GAAP. These are non-GAAP numbers, and you don't find them in NetSuite or your accounting of choice. There's no line for contracted annual recurring revenue or bookings, and this is where finance has to come in and be really strong. And a lot of early stage companies don't have a robust finance function, so they sort of miss out on this. But the finance function adds in all of those metrics. Now, to the other question is, can we tie them back to the P&L? And my answer is absolutely. And I know it's hard, right? And it's hard, it takes some assumptions, but you need to be able to tie it back so that, and where companies get out of shape here, get out of order, is where they might show a lifetime value to customer acquisition cost of 10, right? And like, oh, look, great, we spend $1, we get $10 in lifetime value. Well, that can't be true. Well, if you were doing a 10x, you would be the fastest growing company, in NASDAQ, right? Any NASDAQ company that started out, the benchmark is 0.8 to 1.2. So showing that indicates to investors that you're not connecting it back to the P&L. And so you take your unit economics, and the unit economics will give you, if you trace that back, it should equal your P&L.
And speaking oh yeah.
Well, just to add on that, because this is important. So the rise of Salesforce and all the data it captures, it's great. It's a great system. I use it all the time. It's my go-to system for CRM. But Salesforce touts their software as the single source of truth. And this is problematic for CFOs and finance and accounting people, because the financials are the single source of truth. So the worst thing you can do is have finance calculate these SaaS metrics, and then have sales calculate the SaaS metrics. And then, I've seen this, go to the board with two different LTV to CAC issues. And before the pandemic, I actually took over from a CFO who got in that situation and was terminated because he did that. And so there's a real danger in having two single sources of truth.
And speaking of investors, what are some of the key elements that they look at in financial statements for a SaaS company, and why are they so important?
Yeah, this is great, because a SaaS company has a very specific profile that's very common across. Like, if you look at benchmarks, and Bain & Company has a really good engine called OpEx Engine, database of a large number of customers, and it will show you how the profile of any SaaS company, and it's a 78% gross margin, right? And that's the median of gross margin for SaaS company across 2,500 SaaS companies. And what you see a lot is, if they go to a company and they see a gross margin below that, and I saw this last year, a 50% gross margin, right? And the immediate reaction was, well, you're not pricing it properly. You should be earning, 20 points higher than that, 25 points higher than that, but you're not. So what's wrong? There's something wrong with your company. And then on the flip side, I've seen SaaS companies that present to investors and say, well, we have a 95% gross margin. And that can't be true either, because the cost of the cloud costs, compute, storage, IOPS, the interconnectivity, and then any people you have managing the platform engineer, stability engineer, it doesn't fit into that 5%. And so then you immediately lose credibility, whether you show a 90%, 5% gross margin or a 50% gross margin. So I think that piece is really key in, and this is standard. You pull any kind of like CrowdStrike. I talk about CrowdStrike in my book because they've done really well. But if you pull the P&L, if you pull their SEC filings, you'll see this exact thing.
And for startups with a limited financial history, what strategies or approaches can be employed to present compelling financial statements to attract investors?
Well, this is great. And so going back to my comment, you want to have a target SaaS profile, right? So this is what we think the company will be able to do. And investors will look at the same metrics that I talked about, but they'll also look for the operating mix. And so sales and marketing, R&D, and G&A. And they'll look at that as a mix, as a percentage of total cost. Now, if you're really total operating expense, now, if you're really early stage, you'll have a high research and development expense because you're trying to get your product market fit, right? And then so sales expense at that point should be minimal, right? Maybe some marketing campaigns, some branding, some very basic stuff. But once you achieve product market fit, companies will scale up their sales and marketing teams, and then they grow with that. So it's not uncommon at the very at early stage companies to see R&D expense as percent of revenue at 100% or 150%, because you're building this technology, and even more so with a lot of these AI companies. And then that begins to drop, and then sales and marketing, by the time you hit 10 million, your sales and marketing should be at least 70% of your revenue, where R&D should be 40% of your revenue.
Getting to 10 million, that's the goal, hopefully.
Well, that 1 million to 10 million, those are like the doldrums. It's, a lot of companies can just use their network, their willpower, and get to 1 million. But to create a repeatable sales cycle on a product market fit to get to 10 million, that's the key. And I think Jason Lemkin of SaaSer talks about this, but companies that can traverse that, that 1 million to 10 million, they have a 95% chance of success, meaning they'll get to $100 million because they were able to establish this base early on, which again is another reason why companies need to understand the metrics, understand their business performance at an early stage.
And so how can benchmarking against industry standards and competitors inform strategic decisions around SaaS organizations?
Right. So, and I did reference this, but benchmarks give the CFO, the finance team, credibility, right? So if you, like I said, 78% is the median gross margin, and no one really can argue with me because that's a fact, right? And so when I go in, I say, well, LTV to CAC should be 0.8 to 1.2 in an early stage company, and then someone might say, well, it should be 3x. Well, yes, but we're not there, and here's why. And so, and I do this all the time. Just recently, I was talking to a client, and their services profit was negative. And that person was getting all this grief, like, hey, you're negative, your utilization is wrong. No, I'll stop. We want services to run at a negative, at a gross margin loss, in the short term, because we want to trade off subscription revenue for support, and we offer free support. So because we want the customers to be successful.
And speaking of processes, how would you recommend integrating SaaS metrics into day-to-day operational practices to hope to continue to improve and increase efficiency?
And that's a great question, because SaaS metrics aren't for the board, aren't for investors, aren't for the management team as much, but everybody in the company needs to know that what they're doing is driving SaaS metrics, right? So on a day-to-day basis, if you think of the daily activities of the firm and how, a director or a manager or a marketing analyst, how are they driving these SaaS metrics? Well, in marketing, we're constantly running campaigns, right? So it's different ideal customer profiles, different personas we're targeting. We're doing A/B testing, different landing pages, right? So marketing's always experimenting with different ways to get users, right? And each marketing campaign has a CAC payback period, right? You should know the CAC payback period, and not that the CFO has to go in there and look at it every day, but the marketing people, involved in those operations should know that. And when they're running a campaign and it's the payback period is over a year or over 6 months, and that person has to know, oh, that's wrong. Let's shut that down. And let's move to this other one that has a 3-month payback. And it's not as obvious as you think, because it's not in marketing. SaaS metrics are not something, these are not well known, right? And a lot of times, sort of the, if you will, the rank and file, the people doing the work in the company, they think of metrics as, oh, this is what the board needs. This is what investors need. I don't, my key objectives are to run these marketing campaigns and not report back if one's not doing well or doing well. That's the CFO's. But no, it has to infuse through the whole organization. And let's pick an example from sales. So in an enterprise company, when you have direct sellers, out making the calls, and the motion is really pipeline to bookings, right? And this is called the speed at which the company adds contracted annual recurring revenue can be measured by sales velocity. So every day, so sales velocity is literally the daily contracted annual recurring revenue converted from pipeline to bookings. And so trending below that, right, someone needs to raise their hand and say, hey, this is not what we expected. And then you go in and you find, oh, well, this was delayed, or the customer lost budget and it's been delayed. And it's all this is about, all the top line metrics, right, are early indications of revenue. So if we're measuring this, then we can intervene to ensure success of a contract of sales. And from a CFO perspective, we can provide our customers in sales with strategic information.
Yeah, it's like a temperature gauge.
Yes, exactly.
Can you talk about how the customer-centric model difference in its application and execution across enterprise, small to mid-market, and B2C SaaS models? So all three.
Yeah, so the customer-centric model is something I developed to help people understand what metrics apply and what they should be, right? So the enterprise SaaS company sells to large Fortune 500, Fortune 1000, Global 1000 customers, companies with really big budgets. The small mid-market these are companies that are buying sort of $50,000 annual contract values or lower, 10,000 annual contract values. And then the business to consumer, consumers are buying, so maybe they're buying Mint at $1.99 a month, or they're buying some app, some lifestyle app, meditation app, and they're buying these for $2, $3, $4 a month, right? And these are very different. So there are very different metrics to use between all three, and then there are very different numbers for each. I'll give an example. In a enterprise SaaS company, we have a direct sales force, right? And that's very expensive. And, but we're going after high value targets. And so what we'll see is a long sales cycle, right? We hire a sales rep. It takes them maybe 9 months to ramp up to full production. And then they're spending maybe another 9 months courting customers and getting them working. And so you have to have a lot of money, capital built up to support this long run rate. In marketing, or in business to consumer companies, marketing is key. So you spend in 1 month and you're getting results the following month, or in that month or the following month, right? And so CAC payback period is more applicable to business consumer than it is to an enterprise SaaS company. And on this topic, I'll leave you with a data point. But in enterprise SaaS companies, 70% of the sales and marketing budget is sales. And in business to consumer, it's inverse. It's inverse, right? So 70% is on the consumer, capturing consumers.
And so what are some of the challenges and opportunities associated with implementing the customer-centric approach within each of these subsets?
Yeah, so it's from a strategic perspective, you don't want to find yourself in that small, medium business area. In companies that are trying, if a startup company says, okay, we're gonna sell this product and it's a $10,000 product. Well, business to consumer companies in your space their playbook is to move into your space, right? And so your only opportunity is to move up into become an enterprise company, but you're going to have trouble because there are a lot of established customers up front. So companies so investors will not typically invest in small mid-market, small medium business, and so you have that to worry about. And then it's the go-to-market strategy. It's expensive. You have part sellers, part marketing. You have inbound calls. You have outbound calls. So it's a very difficult market to playbook to execute.
Yeah, that's helpful. And so within this, in what ways do horizontal and vertical SaaS models cater to the unique needs and dynamics of different industries?
Yeah, so I also have in the book I talk about it industry-centric, right? And that's probably why you're asking. So there's a lot to unpack here, but let me be brief. So the first wave of SaaS companies were horizontal SaaS companies, right? And the reason was that they developed these point solutions that applied to every single industry. So Avalara for sales tax, right? Every company pays sales tax, and so every company needed that. So the total addressable market for these solutions was really large. Whereas in vertical SaaS companies, it's smaller, right? If you're just targeting biotech, for example, Veeva Systems is the dominant player in biotech. They don't have other modules, but they're really great in biotech. And so the difference between the two is the playbook for horizontal SaaS is well established, right? And you execute on that, and you have this large TAM. And in vertical SaaS companies, it takes the company longer to get to IPO on average, and that's because the company needs to build the product and tailor it to the industry. So a sales tax module, well, it applies to everybody. You build it, and then you add some features. But if you're serving the biotech industry, right? Well, you have to track FDA approval. So someone who really knows FDA approval will help build that model. And I'll give a data point that will differentiate between horizontal and vertical. But horizontal SaaS companies always have sales and marketing is their biggest expense, and in vertical SaaS companies, it's R&D is their greatest expense because the product itself drives adoption. And so it is some horizontal companies start they'll start as a horizontal SaaS, so maybe data compliance or governance, and then they begin to develop some sort of competency in a certain market, and then they can go all in on that. But the success from those in that playbook has been really mixed.
And so how do they capitalize on opportunities within specific verticals while maintaining their adaptability to looking at broader industry needs?
Yeah, it's a really tough balance. So if you're a horizontal company, and let's say you get some traction, let's say you're a data-based company, and you start getting some traction in financial services or in insurance or in entertainment, what have you, then you can use your R&D and you can start funding, R&D investment that will build features for that industry, right? So if you're managing data for financial services, well, it's heavily regulated. You need to have some data governance. You need to, you need to care where the data sits. It's got to sit, is it close enough for latency to be low so we can accurately check these trades for financial services. The way, if you're a horizontal SaaS company and you want to follow that approach, what you want to do is you pick the vertical that's closely aligned to your product. For example, sales and use tax for Avalara. Well, they can start building out sales and use tax compliance for companies that do business with the government, right? And that's a very specific set of rules, and they can start building that out. There's a company I've worked with, Constellation Software. They are a phenomenal marketing technology platform for biotech. It's heavily regulated. So when they went to other verticals, they thought, okay, what are other highly regulated companies or verticals out there? Well, that's insurance, financial services. And so they began moving into those different verticals with minimum changes to their product. And now they're in life sciences. And so they've really begun to dominate verticals that are adjacent to their vertical where they have a core competency.
All right. Well, we're getting close to Q&A, but we got a couple more questions before we roll into that. So, Eric, you've worked with many, many, many SaaS companies. Yes. And still continue to. So what emerging trends or shifts do you foresee shaping the future landscape of SaaS?
Well, this is really interesting because, and I sort of feel that the SaaS wave, we're up and we're a mature industry, right? SaaS is a mature industry. If you're coming out of college, you're not going to encounter a perpetual licensed business, right? Or if you do, they're pivoting to SaaS. But what I've seen now is the number of SaaS solutions are so great. The universe of SaaS solutions are so great. And within companies, I refer to this as SaaS sprawl, right? So the company buys some, people buy it on their credit card. So the average company in the $100 million revenue range will have 70 different SaaS solutions, some of which they know and some of which they don't, all of which are generating enormous amounts of data. And it's in different formats. That's called unstructured, right? When they're different formats. It could be video, it could be text, could be a PDF file. And so all that data has to be stored somewhere. And so I believe the next phase will really be what we call PaaS, or platform as a service. And these are companies that are going to manage all of this data that's flowing from these disparate SaaS solutions inside a company. And then ultimately, we're going to be able to use AI to collect that data, analyze it, and produce reports. If I'm sure people on the call have been involved in board meetings, and right when board meetings come in, when you get ready for board, finance sort of shuts down for 2 weeks while you're working on the board meeting, and you're pulling information from all these different systems. I know people on the call have experienced this, and it's painful. But if we could have all the data in a single system that lends itself to an AI workload, well, then the AI, we can basically tell the AI, okay, create a finance section for this board meeting. And then, it's not as easy as that, right? You have to get the prompt. But eventually we'll be able to use AI to create a board meeting from the data, our own internal data. And so it's really the PaaS, platform as a service, which I think is going to be next. And these are companies like Mirantis, which is Kubernetes as a service, Event Store, which is it's time-based data as a service, Enterprise DB, which is Postgres as a service. These companies, this is where I think we'll see a lot of innovation along with AI, in hand with AI over the next 10 years.
I like the idea of saving time for board meetings.
Yeah.
How can founders proactively anticipate and adapt to these evolving dynamics and mitigate risks to capitalize on opportunities?
Yeah, the best thing, the best practice for early companies is the software architecture, right? And so you need strong leadership in the product team to build. So if you're building a cloud native product, it has to be fully cloud. You just can't take your code that's written for an on-prem software and dump it in the cloud. It's going to be clunky. It's not going to work. Availability is going to be low. So, it's going to be unstable. So it has to be a cloud native first, and it has to be built in a way that allows for future expansion. And I do work with a lot of companies where 30% of their R&D budget is spent on tech debt, right? With tech debt implying rewriting of code, debugging code. So if you think about that, and I think that's the average from my benchmarks is, as I know, 15 to 30%. So if you think about, that's like a giant tax on the whole tech industry, and it's caused a lot by starting with an architecture that doesn't support the ultimate goal of the company.
Super helpful. Well, we're almost at the time for Q&A. Eric, you have extensive knowledge given this conversation, of course, in SaaS, and you've written a bunch about it in your book. What are a couple of key takeaways from your book, let's say 3, that you'd love our audience to learn from today?
Yeah, I think number one, make sure you understand the definitions of the SaaS metrics. So get the right ones for your company, right? Determine which ones drive financial performance, and then understand them so you can define them at will, and you know it so well. And then get the benchmark so you know what they should be. And this will give you the credibility to support these benchmarks, right? To support these KPIs. And then when you're able to do that, you have instant credibility in the board. And if you're able to define them, you can avoid any kind of high level discussion on, hey, how do you split customers? Or how does LTV really, I don't think you put this in there or that in there. So I think that's my key takeaway on the metrics. And then on the customer-centric model, make sure you know what metrics apply to your business depending on how you go to market. And then the third thing I would say is sort of the last thing companies do with unit economics. Like, understand your unit economics. It'll tell you if you're selling something below price. If you get a non-standard deal, it'll tell you what the margin will be on that deal, and it can either expand or compress your gross margin. So those are the three points that I really want people to learn today.
Awesome. Well, if you have questions for Eric, drop them into the Q&A function. We got a question here around for an ed tech business. What are your thoughts on free trials?
Well, I'm fine with it, because if you look at, and they're good for SaaS businesses because our margin's really high. Our cost to serve, especially on a free trial, where there's not a lot of cost. We don't have to, we don't have to have a customer support line for a free trial. You just do it. And you can, if a free trial is a self-provisioned step for the customer, so the customer doesn't interact with anybody, they put in a credit card, they get the free trial, and then it's a low cost for us to serve that business. So it acts as a strong customer onboarding. Now, obviously, you have to look to see, what are these people converting to, or maybe it's a 14-day free trial or a 30-day free trial, and maybe you capture additional information about that customer and you get value out of that information. So it is a very valuable and valid go-to-market strategy.
And any advice on how SaaS companies can lower cloud costs?
Yeah, this is a great question, and a lot of PE firms have groups that focus on cloud, and so if you have not done a cloud audit internally, or you can hire somebody from the outside to look at the instances you're paying for, the amount of storage, the amount of input-output IOPS, I would do that. I would also look at the code of the software, and so does it require a lot of storage? Does it require a lot of compute? How can we re-engineer it so it uses less compute power? I had a client once that their big thing was they stored every single bit of data that their clients produced, current or past, not in hot standby, but hot server, ready to go. And I asked, like, hey, why are you doing this? It's quite expensive. And they said, well, this is a key value proposition that we store that even for customers that left. And when we look, customers didn't even know how many years we were storing it. It was just somebody in the organization doing what he or her thought was best, but it turned out to be a huge burden on the company. So yes, I mean, it's worth taking a look, a hard look at your cloud costs.
Mm-hmm. Another question here. Is there a strategic or operational difference between SaaS and a service that uses in-house software to serve clients?
Are you maybe talking about a private server? Um,
Mm, yeah, I'm just reading the question here. Service company that uses in-house software to serve clients. Uh,
well, and I'll give you an example where I think I know this, but there's a company that's very secretive, but they provide data deep dive for legal companies. So if you're a law firm, you load up all the relevant cases to your individual case, and then they run that software. Now, because it's so sensitive, when I went there, I had to fill out this whole form just to meet with them. But they everything has to be run internally. They cannot run it on a cloud. And so they have their own data center, their own data racks, their own everything they own and they control. And so it is a capex heavy business. And so in there's a cost to serve from a P&L standpoint, but you also have to understand there's the capex, and that amortization should show up in cost of revenue. So your margin can be lower, so 60%, because you're carrying all of this capital expense. So you have to price it appropriately. So there are very big differences between leveraging the cloud and leveraging an internal self-hosted software to serve clients.
mhm. Speaking of cloud and data, how do you protect your business from a cybersecurity perspective?
Yeah, this is so key. I was just in a presentation yesterday showing malware and ransomware attacks are up, I think, 300% in January over last year, and it's only going to get worse, right? And so, well, when you talk to cybersecurity experts, they look at all the points of access between your software and the internet. And then second, they look at all of your vendors and they look at what the vendors are doing, right? The big Walmart cybersecurity breach before the pandemic, there was a vendor in Pittsburgh and they were hacked. And then through that, they were able to get to Walmart. So it's your own, RDP points is what they call them, but points of access to the internet. And then it's vendors. And then internally, you have the systems and process. You have a password manager, right? You have multi-factor authentication. And then the final piece, and this is the biggest vulnerability, is social engineering. So getting an email saying, spoofing my name to accounting saying, oh, hey, I got this urgent thing. I'm going to close this deal, but I need you to pay for this person's airfare. So send. And this happened once where I replaced the CFO because the CFO was there when it happened, fairly or unfairly. But they spent $100,000 to an entity that was spoofing a legal firm that we used. They went out and they got a domain name that had one extra letter in the domain, so it looked and felt. And they had monitored the traffic, so they knew who was talking, and it was very sophisticated. And now you can read this. I just read this, but a group in China, they had deep fake. So they had on a Zoom call, they had people on a Zoom call looking like the bosses and speaking like them, and it convinced someone in accounting to wire several million to this fraudulent account. So it's social engineering. If you hear that term, that's where you need to look first.
Wow, yeah. Scary world. Let's see another question here. What kinds of team members are essential for a SaaS company to thrive? So let's talk about like in the early days, like where are the key, where are the key pieces?
Well, in the early days, before you have product market fit, you really want to, you take your product team and you build out the product. So it's pure cloud native. It's, APIs that you don't need. It's clean code. And then in your sales and marketing team or people or person, you want to go out and you have to find a pioneer customer, right? You have to find someone who will use it. I mean, even if it's a friend, but you go out and you find someone to use it to validate the software. And then you can rely on that customer, one or two or three pioneer customers or beta testers. And you want to get their feedback manually and incorporate it into the product. That is the key point of early stage companies, a key success factor. A lot of companies fail because they think they have product market fit, but they don't, right? And so they test it on these individual customers, or they don't test it on customers, they test it on themselves, and they get giddy with excitement because it works for them or just works, but they don't know how the customers use it.
Yeah. Let's see. Another question here. What advice do you have for managing website traffic and boosting engagement?
Website traffic, that's sort of more of a product, I guess. But what I would say in terms of marketing campaigns, you really want to have separate landing sites by campaign. Ideally you want codes, but if you can't have codes and you're just attracting people, you want different links to go to different landing pages, and then you want to see how they behave on that landing page. So if you put the link at the top, is that better? Or at the bottom, do you have a password or email to get through, or do you not have an email to get through? And how do those convert down the line? So it's really these landing pages. I think that's a really valuable way to do the A/B testing and then to engage with customers.
And help track.
Yes.
Let's see.
In early stage customers, you're always experimenting, right? With your product market fit, with your go-to-market strategy, with your message, your brand, all of that. Like you're constantly experimenting until you get it right, or you get it right over time.
Another question here. Can you talk about pricing metrics? How are pricing changes best managed? And is it appropriate to price both the data and storage costs with user metrics and other basic subscription fees?
Boy, this is so great, because you need to price to get this 78% gross margin. And I had seen this a while ago, but a company was pricing on a cost plus basis. They looked at what it costs to serve the average customer in terms of cores, storage, data storage, and then the interconnection, which is not much. And they took that and they added 50%. Well, that's a manufacturing metric, right? So what we want to use is value-based pricing to establish that. And we can go in that another time, but and right now everyone's trying to increase prices, and it's hard. But what you want to do is you want to come out with a version 2.0 of your software. Hey, look, new features and functionality, it provides higher value, and then therefore you're getting 20%. It costs 20% more. But then look, it saves you money on that. But you tie it to adding new features and functionality, to the extent you can, right? More or less. And then you charge this higher price. And understand, though, that it takes time if you do it on renewals, or if you do it in your base of customers. Some are paying this higher price, some are paying lower price. So it's not an immediate impact.
Another question, is the NIST framework the best practice for cloud cybersecurity at present?
Ooh, that's out of my understanding. So that's
Got it. All good. Let's see. Well, we're almost at time. We're almost out of questions. But let's see. There's another one here. With generative AI, any great software you would suggest to manage SaaS with success?
Boy, this is also a great question, because, and this is the big kind of industry battle right now. There are a lot of SaaS companies that are starting up with domain specific or industry specific software, like legal or researching, and but for what I use right now is just OpenAI, and I use a private version of that, and then I use it for creating earnings reviews or earnings transcripts, and I prompt that data to see what are equity analysts going to ask, based upon this transcript. What are they going to say? And so it's good training, but I have not found an AI product that works well in the finance realm, or a use case like I discussed earlier. Like, how can we ping all of our data in real time and extrapolate out a dashboard, a base case? I've not seen any specific company software out there that will do that.
Well, your crystal ball was saying platform as a service earlier, so it's an opportunity, y'all.
Yeah, I think that's the new big opportunity, right? I took a prompt engineering course last year, this 7-week course, and it was really valuable, and I'm able to experiment with it on my own. But I think eventually people who are far more skilled than I am in prompt engineering are going to create these different businesses, either based on OpenAI or using their own AI, to do the stuff that I'm talking about, because I'm reaching my limit, my knowledge limit, trying to create a board deck from our unstructured data.
There you go. Well, we're almost at time. Eric, thank you so much for sharing your expertise. Based on everything that we've talked about, what's the golden nugget you want to leave our participants with today? The
most important thing is, learn the SaaS business. SaaS has always been an apprenticeship business, right? And it took me 10 years to get a deep study to do that. So learn the SaaS business before you're caught unawares.
Awesome. Well, you can learn more about it in Eric's book. And to everyone out there, thank you so much for joining us. Eric, again, thank you for sharing your expertise and your knowledge with us today.
Great. Thanks for hosting me. I really enjoyed it. Thank you.
Awesome. All right, everybody. Well, we thank you again for joining us, and we look forward to welcoming you back online soon. Have a good one, everyone.
That's great. Bye, everyone.